All right, so stock started off the day really well. Good, nice opening gap that filled in a gap from a few weeks ago. Things were looking outstanding and great. Like we were getting some of the bullish signals we were expecting or wanted to get, from Friday's video that would signal how bullish we can be now going forward, the actual reversal. And it would have been a good validation of those Thursday and Friday move, which kind of seemed to come out of nowhere. A little bit of fake out qualities to them, but would help to lower the probabilities of a fake out until the end of the day. And really, the Russell 2000, as you'll see, never really had that good of a day today, which might be a little bit of a sign to come of what's to come with the rest of the larger cap indexes in the broader market. So I'm going to break down what the end of the day did to a lot of these signals that we've been looking for, what the Russell may be telling us about what's to come, what really drove this price action today, what happened in bond yields and the yield spreads. We'll take a look at that, as well as the dollar and other thing and commodities too. And then our trade of the idea of the day is a stock that in and of itself is on a pretty good bullish pattern and a bullish bounce pattern itself. And if the markets are to reverse back up to the upside, it looks like this particular stock may offer some relative strength. So we'll talk about how to trade that to add some bullishness to the active trading portfolio. So let's go ahead and get started. Today is Monday, March the 6th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon and the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things, other things over here on the right, including our Market Outlook live video. Come down here, click on this heart. It opens up this tab. Hit that like button. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you like and share these social media posts, it really helps us get our content out to all of our followers on those platforms. So thank you all for those who do that day in and day out, and those who don't, you can do right now while you're watching with 1 or 2 easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator. As you can see, we did rally early. We gapped up. We rallied early. We actually filled in that gap. Technically we actually closed above here at 40.45. The high here is 40.52. So I guess we didn't technically close above it. And today we were above it for most of the day until the very end of the day. We closed at 40.48, right below the high of that bull tag day. Right below it. Near term, the momentum line fell. Now the momentum line was lower at the very low of the day, so it's not as bad as it was. You'll see here in a minute, the Russell 2000 really had a bad day. But you can see again, we did not get above the moving average. We closed 1/3% below it. A little bit of a long upper shadow there. We do have light green shading still. The intermediate line is rising, but it's in bearish territory. We do have a yellow line. We are below it, but it's rising. So you can see like we're kind of quasi-neutral here. The market sentiment line's actually rising, so it's been going up and down, but it's really flat and right along the bottom end of that. I guess the top end of neutral zone, right at the low, right near bullish territory there. So very interesting day today. At the highs of the day, things were looking really good. Again, we filled in the gap of that runaway gap there. And like I said, we were well above that high. I mean, we were easily above the high at 40.78. We would have closed well above that going into Powell's testimony of the next couple of days. So a very significant move. The problem is we didn't hold it. And you look at the Dow Jones and you say, okay, well, the Dow Jones still 0.5% below. And same thing, the near-term line stayed up at higher levels. Momentum line's already dropping into bearish territory. You can kind of see here again, nowhere near the high point of the bull tag there. The bull tag is a little bit earlier. Remember, the bull tag on the S&P was actually on this day after expiration. For the Dow, it was a couple days before. But we're not even closing above the high of that day either. The Nasdaq's a little different story. The Nasdaq has been more bullish. On Friday, you see, we actually did close below the highs of these bull tags here. So it was a really strong day on Friday. In fact, we closed above the high of that day post expiration. So really strong day. We filled in that gap as well today. We are above the moving average, but again, momentum lines already dropping. Intermediate lines rising, but not in bullish territory. And then finally, the last thing that really stands out is this big drop, huge drop on the Russell 2000. In fact, we closed below Friday's low point on the Russell, so it was really bearish. The near-term line's down, the intermediate line's flat. So it's actually down a little bit, so you got the pink shading again. And you can see not anywhere near the high, the closing above the high of that bull tag. Again, the day after options expiration. So you can kind of see like the S&P looked great, but the Russell was like, oh, maybe we, like all day long the Russell was falling, kind of making you a little skeptical about what we're seeing on the S&P. And so by the end of the day, everything else followed suit, as you'll see when we look at the intraday chart. Everything ended up falling down to where the Russell 2000 ended up being. So as a result, if I were to go back, and you see we got the drawing set here on, you can see again, like Friday we did close above these important Fibonacci levels, 38 on the correction, actually 38 on the correction, 62 on the intermediate run. So, I saw something from Tom Lee saying that we've been bullish for the last 6 months because we, remember we bottomed out here in October, really the end of September, and we've been bullish ever since. Going about to finish the month of March, two bullish quarters. But what's interesting is like we've had this intermediate decline, which has been the third leg down of this long-term correction we've been on. But aside from a couple fake out days, we have not broken above the 78% retracement and flipped the script from a bearish trend to a bullish trend. We've just, there's lots of dark green shading and a green line in there. But see, the Dow Jones Industrial Average has flipped that up. We did get here, if I were to move this and draw it on this side, on that same intermediate decline here, you can see we did get above the 78% way early here in November, and then has stayed above it this whole time. When you look at like the NASDAQ 100, again, so there's that same line. We haven't even come close. Like we got the exhaustion gap got up towards it, but not even close to getting above it. And then finally your Russell 2000. Remember the Dow Jones got above it here in November. The Russell 2000 also had a little bit of a fake out there on that September 2nd exhaustion gap, only to fail and come right back down. So as long as we've been, quote unquote on this bullish trend, the reality is we haven't changed the trend. Except for the Dow Jones, we haven't, gone above the 78% retracement and stayed there of this last intermediate decline we have. And that's kind of what you need to see if we're going to have the impulse moves be to the upside and the pullbacks be to the downside. As of right now, you still would expect impulse moves to the downside and the pullbacks coming up until we see something different in that regard. Let's take a look at and especially considering how long it's taking. 6 months and we still haven't flipped that script there, except for on the Dow Jones Industrial Average. If you look at the weekly chart, so remember we did get, let's see here, let's zoom in a little bit closer. We closed at 4,004, 4,003, so we did get a slightly lower. Obviously, this is a higher close so far this week. We are already above that body on this case. So this is, we're skipping the transition. We already have a reversal candle. As of right now, a reversal candle with the green arrow, rising line, and you can see the PPOs rising. So really good from that perspective. The Russell 2000, on the other hand, remember, is not so bullish. Here, let me go back to this one. Let's type in the Russell 2000 here. The Russell 2000, you can see, has not been so bullish and still has, it's been multiple transition candles coming off of the bullish trend and still looking like we might be rolling things over. Remember, the Dow Jones, which was previously so bullish, has been more bearish and still has the red arrow. Now, it's got a higher close. It's not closing above the body, so it's not a reversal. It's a transition candle, but it's again less bullish than what we're seeing right now in one day for the week on the S&P 500. Of course, looking at the 3 green arrow chart, we have 2 green arrows in the S&P 500, 2 green arrows on the NASDAQ 100. 2 green arrows on the diamonds, and one green arrow on the IWM as we fell back below the moving average today. So we came really close to having 3 green arrows. In fact, we did earlier today have 3 green arrows on the S&P, and we didn't quite get that. The Nasdaq 100 came really close to having 3 green arrows with that last one on the MACD, and you can see the Dow Jones also was briefly, barely above, and you had 3 green arrows. So we were really, really close to getting green shading, but as of right now, we don't have the pink shading. And you can see too, when you look at the 2-line versions of this chart, the S&P still just filling in gaps and failing at the 30 so far, a little bit of a long upper shadow. MACD and stochastics are rising above their moving averages. So let's see if we can't finally break. I mean, it's again, when you don't break above 2 lines at the same time, in this case, the 17 and the 30, 2 of these intermediate lines at the same time, then it gets hard to really get a trend, get a good thing established. You have to fill in gaps first, and that's right now. That's kind of what we're doing here. Let's take a look at some of these other oscillators for the S&P. You got you got that positive reversal here on the DMI, so that's a good sign. The RSI and the CCI are back into the upper halves of their charts. They're obviously not in bullish territory, but they're not in the lower half of the charts yet, in bearish territory. So that's a positive development. The stochastics is flirting with breaking into the upper half of the chart and above its moving average. You can see how close we are. We were actually through there earlier today. Looking at the Ichimoku cloud, you can see we're still at the blue line. The red line is got a small positive rate of change, and you can see we're kind of following this along. So we've really got to take off here if we're going to have a renewed positive rate of change on this. You can see there's no trend as of right now, and of course your bands and your Keltner channels, we are in the upper half of the bandwidth, but we're nowhere near the upper quartile. And you can see the bands are outside the Keltner channels, and you're losing the bearish momentum now with green dots. So if this is the extent of the bearishness, you can see that we may be transitioning more towards a pretty decent bullish move here pretty soon. Looking at the intraday chart, getting a higher high, higher low, closing up above, spending most of the day up above the midway point, but closing back down towards it, right back towards last week's high point, which is at the end of the week here. Filling in the gap from this morning. Remember, you still got that gap right there that's actually prone to be filled in. The Arun indicator, obviously we don't have a new high, so the green arrow is still down there, but it has hit 0, so it's set. The red line is, it's been a few days since we've had a new low, and it doesn't look like we're going to get a new low anytime soon. So the more that low continues to move this direction, the more this red line falls. And once it gets below 70, then we're going to be susceptible for that breakout. So that's by the end of the week. As long as we can avoid any new lows by the end of the week, then we're really set up pretty nicely for a bullish move coming out of a really important week in terms of jobs numbers and things like that. Powell's testimony and what the Fed may do going forward from here. Let's take a look at the, I wanted to show you the McClellan oscillator as well. The McClellan oscillator, remember, yes, on Friday got up to a pretty decent level. It wasn't positive, but it got up to a very small negative number. It went back to minus 20. Now, again, 35 minus 35 are kind of the anecdotal levels that I watch for to see, is it really moving in a direction that it will stay there for a while. So we are back down, but that's not necessarily a strong level. The thing is, though, that, again, we're back below that positive 500 level, and the more negative numbers we have, the more likely we are to make our way back towards 0. And crossing below 0 means we're on the wrong half of this summation index, and that's how bearish we are. And so we want to avoid that. If we're going to be bullish, we really want to avoid that. I don't believe that. I think the likelihood is we can't. I think the likelihood is that we will fail here and stay in the lower half of this money flow index and the McClellan oscillator. You can see the new highs and new lows did drop back down. Still a little bit above the average, but back below 100 there, so not really breaking out there either. So you can see we are, from a breadth standpoint, we're not necessarily back to like all steam ahead, so to speak. You saw the volume and the range today. a little bit below the average on the volume, a little bit more below the average on the range. So very small numbers. You're looking at the volatility. It was up, but not very much. And you can see we actually ended up here in neutral territory still for another day. And the correlation now is back up to really strong levels on the VIX and the VIX on the VVIX. You can see we're still below 20. We're actually still below 19. And the VVIX is still right near 75. So the VVIX itself is still at extreme lows with that strong correlation back up to 94%. Again, a bounce off of extreme lows would lift both up, the VIX and the VVIX, especially as I mentioned to you before, in a seasonally bullish time of year for volatility. So we'll see if the catalyst that would spark the VIX up to its average levels, and even just for 20 years, the average levels are up to above 20% for the year, and we're at 20% down for the year. So we'll see what ends up if we do rise. If the Powell testimony ends up being the catalyst that gives us this last leg higher that generally ends up being a higher peak than what we generally see earlier in the year when we were briefly positive on the VIX for the calendar year. All right, now let's take a look at what's driving this action. You can see we had, over the past 3 months, we were positive. The rate of change for equities had slightly turned negative. So over the past 3 months, just the S&P, IWM and the Qs were positive still, so they haven't turned down yet. But the S&P had slightly turned negative. Of course, bonds 3-month returns have turned negative. The dollar's 3-month return has been negative for quite a while, had briefly turned positive, on a 3-month basis there. So you can kind of see how things are getting a little not as strong as they had been. Again, we started off very strong here today, and you think, okay, things are, if we can really hold this, things can really take off from here. You can see bonds were up, which means yields were down, but then yields rallied throughout the day. Bonds ended near their lows, stocks ended near their lows, both the Qs and SPY. IWM was just on a tear to the downside, all on its own. Commodities started off down, but they rallied throughout the day. Gold was weak all day long, got weaker gradually throughout the day as the dollar was weak early and then stayed down for the day. So quite an interesting day. Again, the TNX, the 10-year yield is the thing that's been making a significant move. It started really low at 3.9, below 3.9%. Near the open, but then rally. Again, the MACD is below its moving average. We are not below the 17-day moving average, however, and we ended up back above the 8. So I don't think there'll be a whole lot of momentum to the upside for the yields, but we're still not necessarily below that 17-day yet. TLT made a run to try to get above the 17-day at the open. Again, MACD's already positive, but then finished back down below the 8-day as well. So again, I don't see a whole lot of downside momentum in bonds, but I also don't, we're also not back above the 17, and we're below the point of control. We're below multiple moving averages still. The 30 is about to cross below the 50. They're all below the 200, so we're still in bearish mode. Of course, the dollar is a big factor. It's been pulling back a little bit. Commodities is a big factor. It had a great day on Friday. It started off lower today and then rallied. Remember, commodities are kind of this catch-22. We want it to be down so that it doesn't impact inflation levels, but we don't want it to go too far down to where it's corrects, because again, commodities don't correct during bull markets, right? So if it can pretty much just stay sideways here, then at least that tames the growth rate of price level, even if they remain high. It tames the growth rate of it down to low levels, and that's kind of what we all really want. But it also means that there's enough demand for it to still be up here, that the economy is growing. I think that's kind of your sweet spot. You don't want to get back above here because that renews inflation pressures, but you don't want to get below this 38% retracement either. And for the last 6 months or so, it's been squarely in that sweet spot. And partly the reason why the markets have been as bullish as they've been. The economy has been strong enough without the inflationary pressures. Of course, those pressures are renewing. You can see that. The Cleveland Fed's expectations ramped up again today. The core CPI is expected to be the same growth rate from one month to the next. On a year-over-year basis, you can actually see the core is expected to rise back up again. So that's a pretty significant change. You can see we're expected to get down to 6.21 on a year-over-year level. When you look at that here, to kind of give you an idea of where we are, since June's peak, we are 1, 2, 3, 4, 5, 6, 7 months. Going on 8, that's expected to be a 6.21. 1, 2, 3, 4, 5, 6, 7, 8 was back in October 2021, and we were also at 6.23 there. So 6.21 would be a really good level. The problem is the next month we're expected to move up. The headline CPI is expected to go down to 5.4, but the core is expected to move higher. And that's the problem, right? The core CPE is moving higher, the core CPI is moving higher, and that's what's not dropping, and that's the problem the Fed has. Is they're not able to get the core levels down, and those higher pressures are just putting pressure on equities and keeping them from really being able to take off and keeping the Fed in rate hike mode, which you can see 30% odds that they're going to raise 50 basis points. And it wasn't too long ago that the odds of us going up 50 basis points, February the 2nd, the odds were 0%. We're literally 0% on February the 2nd. And then now they're at 30%, right? Today, moving back up to 30%. So when you look at, the odds of being at 5.5% at June, on February the 2nd, the odds were really low, 30%. Actually, on February the 2nd here, 30% there. And now it's pretty much 100% will be at 5.5% by May. So things have changed dramatically, and that's why you see the S&P down as much as it is since that February 2nd time frame. So here's February the 2nd, right there when commodities were on their way down. Commodities are pretty flat since that time frame, but yields are not flat. If you look at where yields are, there's February the 2nd. We were at 3.39%. Now we're at 3.98. And then you look at the S&P 500, and you can see on February the 2nd, we were up here, and now we're down. So things have changed. They haven't changed very much. As you can see, for example, since if you go to the asset class comparison chart, if you go from the 2nd going forward, so starting on the 3rd, going forward from here, you can see again the dollar is still very strong, commodities are now positive, and bonds are still way down, and that's put some pressure on equities, international equities more, emerging markets more, but IWM is still down 5%, SPY still down 3%, the Qs are down significantly, down nearly 4%, again off their lows, but still down because of the higher interest rate hike odds that don't appear to be going anywhere for the end of the year. Again, going through the end of December, you can see on February the 2nd here, I'll be right there, the odds of being at 5.5% were at 0.08%, and now they're at, over here, they're at over 60%. But you can see currently today, the odds of being at 5.5% are right around 75% now. So just like that, the odds for rate hikes have increased up to 5.5%, and the odds for rate cuts by the end of the year are almost gone. So that's how fast things have changed, and you wonder how much impact. Again, the bullish narrative is built on the fact that the Fed's going to be cutting rates, right? That the Fed's going to start to accommodate and take away some of this restriction. Well, as you can see, the Fed's not restrictive yet, right? The real Fed funds rate is actually still negative. This will be updated here soon, but it's actually still negative. So until this goes positive, then, again, it's going to be hard for the Fed to start dialing things back and being, quote unquote, accommodative again when they're really not even restrictive yet. All right, so for our trade idea, I wanted to take a look at Marriott. And you can see Marriott's had a nice little bounce back up. Remember, the bull tag for the S&P is right here. We're easily above those highs. Marriott got its bull tags a little bit later, light pink shading in the yellow line. intermediate line cross below its market sentiment. There's actually rising in the bullish territory. And then has since bounced easily above all of these highs. In fact, it did it kind of on Friday, but really solidified it today. So nice good bounce up here. You can see its weekly chart. Notice that it's easily on an upward trend. It's had some lower highs, but it hasn't reversed and closed below these bodies to really reverse to the downside. Now we're back up to a rising PPO, rising candle. So things are looking pretty good from that perspective. You can see we're above all these moving averages. We have three green arrows again, the MACD and stochastics. Stochastics is really close at 24.85. So when you look at it actually on this chart, you're really close. The MACD is barely negative. Stochastics is barely below 25. So you're that close to getting all three green arrows. And like I said, you're above all these moving averages here. Let me go back to Marriott. You're above the point of control. You're flirting with getting above this last volume node and above the value area and being bullish again. There's the MACD, and you can see right here. You can see it's actually slightly positive because the MACD is above its moving average and it's above zero. So in the stochastics, like I said, is almost there. So, I mean, that's a pretty good move. We are off the high, so it did pull back late in the session. So that kept it from being as bullish as it could be. Its DMI is back up above 30, back below 20 on the negative indicator. So the ADX is set up to move back up. Both the RSI and CCI back up after brief moves to the downside and to the low end of its bullish zone. It's back into the upper end of its bullish zone. Looking at Ichimoku cloud, you're still easily above the cloud with a positive rate of change. You don't have that bullish trend anymore, but you don't have the bearish trend either. And you can see your stochastics when you like the S&P flirting with crossing back above. It already has crossed above the midpoint, but flirting with crossing back above its moving average. Here's the Keltner channels. You can see we are into the upper quartile. Late pullback, like I said, most of the day was actually easily in the upper quartile. We pulled back, but happened to stay there. The momentum was negative, but the bands are inside, so we are set up for a breakout. The bandwidth is really low, and the bandwidth is really narrow. The 150-day range is really narrow. So again, we are set up for a good breakout move to occur from this. And you can see with the weak pullback, you'd expect that breakout move up here to the upside. So here's an opportunity. If the markets do make a break, that we can add something that's got a really good chart itself for a bullish trade, regardless of what the market's doing. That can outperform if the markets rally while the markets are rallying. So what we decided to do is buying the at the money put going outside of that 40 delta, so I can go without using a stop order. I ended up buying a 490, right around 490. Which is about my total risk I'd like to take anyway for one contract for my whole position. So it works out just fine there that I don't have to use a stop order. Most likely not going to get stopped out. You can see if I analyze this trade here. Most likely not going to get stopped out there. So my total risk, here, get rid of that one. There we go. My total risk is at that $500. And you can see by May expiration, if we do continue to trend higher, even at just one standard deviation, you're looking at about $1,000 reward as of right now, and then some. If it continues to move higher, you're looking at a 2-to-1, $200 or higher. You're looking at a 2-to-1 reward to risk ratio. But again, you're more than likely not going to lose the $500 because, in fact, it's pretty. You'd have to hold this all the way to expiration to lose all $500. That's the beauty of buying out of the money. The downside is it takes a long time to get a reward going. The positive side is it's very unlikely to lose. In fact, more than likely you'll end up losing about half of that, $250, and again, to get to $500, which is a 2-to-1 reward to risk ratio, you're looking at about a move up to about 195 is what it takes. So right into this area, and you're getting about a 2-to-1 reward to risk ratio back up to its 52-week highs. All right, well, that's it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow us and like our posts on Twitter and Facebook. Have a great rest of your Monday night, everybody, and we'll see you all next time.